Hi guys, thank you for joining today's In Your Shoes event. Today we are very glad to have Art Dicker as our guest speaker. He's gonna talk about startup funding with corporate VC. Thank you for the supporting from WKO, We Hustle, Tech Quartier, Neo Bay, and episode. Today we will talk about what kind of funding environment are we in now. How can startups reach out to suitable investors, and the legal tips for startup receiving corporate? What kind of funding environment are we in now? We see that in Chinese VC environment, there were a very good trend of growing up from 2012 to 2017. The VC environment is just booming. And after that, starting from 2018, the VC market is cooling down, and we see a downfall starting from 2018. And in this VC environment, how can the startups still get funding? That might be a very great question we need to think about for the startups. So although the whole environment is not that great as before, as 2 or 3 years before, but we still can see a very good trend that CVC are growth gradually in China, and they are doing great, and they are very stable at venture capital investment. So CVCs tend to be seeking more for the industrial synergy, and they are seeking for more long-term investment, and they tend to be more generous in investing in a single deal. So we see a tendency that CVC play a bigger and bigger role in the VC investment environment, and we see they tend to be more generous compared to traditional institutional investors. They have longer investment periods. So don't you think corporate venture capital is very interested to those startups? So I'm Ian.yu. I'm Shanghai local from XNode. I joined XNode last year. Before that, I went to United States for my master's degree. I learned finance in Chicago, Illinois. After that, I came back to China. I was starting my career in a private equity firm, which was mainly investing those later stage startups in the entertainment vertical. So after that, I joined XNode. I helped the scale up department to do the cross-border accelerations. I helped those foreign startups to find an angle to penetrate. So now let's welcome our guest speaker, Art Dicker. He is the director at R&P China Lawyers, and he is a China-based lawyer, and he also writes, and he is a popular podcast host as well. So why not, Art Dicker, please give a introduction of yourself.
Sure. Thanks, Ian, and thanks XNode for having me on. I love everything you guys do, and so it's a real honor to be a part of this webinar. And yes, so quickly about myself, I'm from the U.S. originally. When I went to law school there and graduated and started out in New York, also doing some private equity legal work. And then I just really wanted to come back to China because I'd spent time here studying the language. So I came back and I've been here for 13 years, starting in Beijing and then the last 9 years here in Shanghai. I've worked at international law firms. I've worked in-house at American technology companies, and all along the way have helped a lot of startups and worked for a lot of venture capital funds as clients. And now I'm at R&P, and so happy to be on the program.
Yeah, thank you, Art. Let's kick off the topic with what's the difference between corporate VC, traditional institutional VC, and angel investors.
Yeah, so I think, let's separate angel investors first. Angel investors really, obviously they write smaller checks. They invest anywhere from, a check size of, let's say, 10,000 US dollars up to maybe about US $200,000. Mm-hmm. They're really, they're very early stage. So usually a company will typically get funding from the founders and then from maybe family and friends. And then they might reach out to angel investors. And angel investors are just high net worth individuals, right? Mm-hmm. They generally are successful with their own businesses, so they have some experience that they can offer and help, and they also are good at evaluating companies. But it's their own money that they're investing. And so because it's their own money that they're investing, they actually tend to be a little more risk averse, as you otherwise might expect. Even though they're investing at such an early stage in the company's growth. Now, corporate venture capital compared to institutional venture capital is a later stage of an investor after angels come in. And typically, institutional venture capital fund will usually have at minimum about $5 million to deploy over the lifespan of the fund. Those are micro VC funds, but they obviously get much, much bigger, all the way up to the SoftBank Vision Fund, up to $100 billion. And so everything in between. I think the differences are pretty much, both angel investors and institutional investors are looking for a return on their investment, right? They're strictly looking for a financial return. Within that, institutional venture capital funds will put a lot of bets on multiple companies, and each of them wants to see a TAM, a total addressable market of big potential, right? And that's the idea, that they invest in 10 companies, let's say 20 companies, and they want one or two of those companies to really do very well and make up for most of the companies that they invest in which will not do well. Corporate VC is a little different. Corporate VC invests for more strategic reasons. And so the return on their investment, the IRR that they're looking for, is always nice to have, but it's not necessarily the key thing that's driving their investment. Yeah, I've got a lot more I can talk about that on that topic, but I mean, I think let me just elaborate a little bit more, because I think there's a lot in this question. Typically, I think corporate VCs also look at investing in companies both for strategic synergies that they can get out, cooperations, partnerships down the road, maybe to acquire that company down the road. And then within that, I think corporate VCs also have a little bit of FOMO, which is kind of a fear of missing out. Big corporations have a lot of their internal R&D, but then they're not always completely in the marketplace for where new ideas are coming up from the ground, from the grassroots, right? Where startups, especially in B2B sectors, are inventing and innovating in ways that are faster than corporations can move, right? Because of internal process, often. So a lot of times, corporate VC operates as almost like a keeping tabs on what's out there in the market. So that's another way I think corporate venture capital looks at how it goes about looking at startups and investing.
Yeah, very interesting. Yeah, startups will be suitable for those corporate VC investments. Yeah,
sure. I think, I mean, generally speaking, I'd say B2B is a little more suitable for corporate corporate venture capital. Maybe less so on marketplaces, B2C. Certain sectors tend to have more active corporate venture capital deployed. For example, semiconductor has obviously Intel Capital is one of the oldest, if not the oldest, venture capital funds in the world. And so semiconductor tends to have a lot of corporate venture capital. Automotive is another sector, healthcare and insurance. So some of these more business to business sectors will be looking at opportunities to invest in startups more so than consumer sectors. Having said that, in China, obviously we see companies like Tencent, which of course is both B2C and B2B, and they're investing in everything, right? So, and even Ali, has its B2C platforms and its B2B platforms. So we can see in China it's a little more mixed, and so maybe if you're talking about startups that could be potentially invested by corporate VC in China, the net is a little wider.
Okay, yeah, understandable. And do you think there's any difference that the corporates is investing from their China entity, or they are investing from their global headquarters? Because there might be some decision mechanism. So would you like to share more about this?
Yeah, I think I can talk a lot about this in particular because it touches on a lot of issues. So some funds, again, I'll go back to the example of Intel Capital, where they've been established in China for many, many years, and they tend to have a mature team here on the ground, and are very localized in that sense. You have other corporate venture capital funds, which maybe still a lot of the decision process flows back to the headquarters in the US or Europe or wherever. And so those funds, those corporate venture capital funds tend to have probably a slower decision-making process. Obviously for a startup that can affect, these days startups are almost always in fundraising mode, in good times and bad. And so that can affect your timeline for fundraising. Now, the other thing I should mention is that corporate venture capital, in most cases, tends to co-invest, meaning they don't necessarily lead around. And they usually are not necessarily the first professional money invested in the company. So like I mentioned before, you might have family and friends, angel investors, and then you're going to have a proper institutional venture capital round. And maybe in that A round, you might start to get a corporate venture capital investment to tag along with an institutional venture capital. But it's rare, again, I keep using the example of Intel Capital. It's rare that someone has a large enough team on the ground in your location to lead, to have maturity and experience to lead around, especially at those earlier stages, A round or even earlier. Some teams do that, but for the most part, they tend to tag along. Now, these days, it's a very interesting time because we can see in the market that a lot of institutional venture capital, now maybe not the top tier funds, but maybe one or two steps below the top tier funds, the Sequoias and the GGVs of the world, we see a little bit of slowdown in investments. A lot of the funds that have raised capital have funds which are, they finished their fundraising, let's say in 2015, 2016, which was really a high watermark of when it was an ideal time to raise a fund. And the way funds work, they have an investment period, and it's typically 3 years, give or take. And for those funds, a lot of those funds having raised 4 or 5 years ago, they've deployed their capital already. So in some ways, there's might not be, regardless of COVID-19, there's not necessarily as much capital out there to invest right now.
Yeah.
At the same time, I do want to say one more point. These funds have to invest. So a institutional venture capital fund cannot just sit on its capital, because for them, the clock is always ticking on their IRR, right? They need to deploy their capital. So even in these difficult economic times, even in these times when travel and doing normal due diligence that a venture capital fund would want to do is challenging, these funds still have a requirement that they need to invest their capital. Now, corporate venture capital is a little different, because corporate venture capital primarily gets its funding from as a budget, as a line item in a bigger budget of the corporation, right? It doesn't have LP investors backing it with a finite timeline for investing and exiting from the fund. So that's one other thing to be aware of, is that regardless if it's regional or local corporate venture capital, the strategy and the funding that they have is a little more dependent on year-to-year budgets and the direction and the economic status of the company.
Yeah. Like the institutional investor are more constrained to the like the investment period, and they value more the like time value of the money. So they have their constraints. Yeah.
Exactly.
So, like because of these decision mechanism of corporate VC, how would you think it's the best way for these suitable staffs to ask for these corporate VC investments?
Right. Well, ideally, you have the corporate VC investments coming after you, rather than you seeking them out. So usually, like I said, the corporate venture capital may not always be the first capital in. So when you're actually looking to raise outside capital, that's one thing you'd want to look for. You'd want to look for either from your angel investors, who may often in their day job, their real job is working at some of these multinational companies, or some of these companies that have a network that could find you corporate venture capital down the line. So you always want to ask yourself, from my existing investors or my potential investors that are coming in, what can they offer beyond just cash, right? So angel investors can actually be a good starting point for that. Going on then to institutional venture capital, a lot of institutional venture capital works very closely with corporate venture capital on deal after deal. The institutional venture capitals may have a specific industry that they like to focus on, and then it's natural that they partner with corporate venture capital in that same industry. So that always, when you're looking for corporate venture capital, go and look at your existing investors to see what kind of relationships they have. One thing I'll say to be cautious of about, and that goes in general, but it's specific for corporate venture capital, is, obviously everyone, I'm sure listening here knows about the Tencent, Ali ecosystems here, and a lot of times startups in China, if they're raising from local venture capital, corporate that is, have to make a decision relatively early on in their lifespan of, am I in the Tencent universe or am I in the Alibaba universe, right? Because those funds have those corporations have a whole network of companies that they work with in their ecosystem, and usually you end up having to pick one or the other. If you're outside of that space, let's say you're in automotive, for example, you still have to be a little conscious of it. It varies by industry. So I would say something like semiconductor. A semiconductor is a technology. It's an enabling technology. It powers other applications. So if you are looking at corporate venture capital partners in that industry, you may be less likely to have to be locked into one with one player or another.
Yeah,
if
definitely.
you are in automotive, for example, you may have a temptation, let's say your self-driving car technology or something like that. It may be very natural for you to start working with your corporate venture capital investors. You just have to be cautious of later on down the line, are you then stuck, for lack of a better word, with that corporate venture capital partner, and you may not be able to easily work with their competitors if that ends up being a better fit for your product down the road. So that's something I would say when you're approaching corporate venture capital, or when corporate venture capital is approaching you, you're naturally going to be aware of positive synergies, but also be aware of the potential negative synergies or locking yourself into a certain ecosystem.
Yeah, very interesting. Yeah. We know, like in China, we have this BAT back ecosystem. We cannot ignore it. And also, like, startups should be cautious to these big giants. And on the other hand, why I'm thinking about startups should look more for the corporate VC investors is that in some case of the institutional investor, correct me if I'm wrong, like the institutional investor in China tends to add many terms about like the revenue, about the income, about some repo terms onto startups funding, and corporate tends to be more generous, and they are seeking for the synergy with in the business. They don't put that much constraints into the investment contract.
Yeah, I think that's absolutely right. And I think the reason for that is if you just look in the difference between corporate venture capital and institutional venture capital, again, it goes back to the fact that institutional venture capital the clock is ticking. And they're in it for a return. And what that means is the terms that they put into the investment contract tends to give them more control. It gives them veto rights over, for example, decisions to change the business, on bringing in new investors, on a lot of other things that could somehow affect the value of the company. And they do that not necessarily because they actually expect to use any of these rights. They also put in certain economic rights, for example, getting a preferred return, and a first money in, first money out, and a lot of other tools or hooks which can be used as leverage. And they're there sitting as leverage just in case there's a difference of direction, maybe a difference on timing of what maybe the founders of the company are not looking to do an exit, meaning M&A trade sale or an IPO so quickly, but a venture capital fund, an institutional venture capital fund, needs to get its money out. It can't just keep having its money sit there because these funds have a life cycle, they have a term, they need to return the money ultimately to their investors. So there's going to be a little bit of tension there, which may not be there if you're a corporate venture capital investing into a startup. So because of that, you're exactly right. The terms will be a little different between what the corporate venture capital investor asks for and what the institutional venture capital asks for.
Yeah. Yes, exactly. Thank you for the sharing. And then if there is a case that the startup is very difficult to find, to seek for the corporate investment directly, they do some kind of startup corporate open collaboration at first to get to know to each other first?
Yeah, I mean, I think we've seen a lot of these coming out. I mean, I know XNode is involved in these kinds of programs as well. It's these kind of accelerator programs, corporate accelerator programs. I think they're great. I think a lot more corporations are looking to these kinds of programs as a way to not just hear about great ideas and be closer to what's happening in the market, as far in the market of ideas and the market of innovation. But also, I think a lot of these programs, it's a great opportunity for these companies to bring their staff, which may have an otherwise relatively routine 9 to 5 or whatever day job, but then let their team work with these, young dynamic founders who are doing really interesting things. And then, of course, from the founders, the startups perspective, they get great relationships. They get access to what that company is seeing in the marketplace, in beyond what in the customer base and their potential customer base down the road. I think one thing I would caution a little bit about is most of these programs are not terribly restrictive, right? It's a relatively open cooperation. If you are working with one of these accelerators from a startup perspective, just be sure that it's clear anything that comes out of the cooperation, who owns the IP from that joint work. That's probably one of the most important things to look at. And I just would say, in general, whether it's one of these programs or if you are getting actual investment from a corporate venture capital fund, be aware of IP ownership, access rights to information. This is more for the investment side. If you're getting investment from a corporation, just be aware that they're going to maybe ask for certain information access rights, maybe even some non-competes. Now, most corporate venture capital it knows that that's going to put the startup in a difficult position, so not necessarily going to ask that. And that's even less of an issue in these kind of open collaboration programs. But just when you're working with companies that are much bigger than you, just be careful to read the terms and conditions and understand the relationship that you're getting into when you're working with big companies.
Okay, that make perfect sense. And thank you, Art, for the knowledge and the legal tips for start funding with corporate VC investors.